Let's see, and the thing that I'm going to be talking about today is escaping from the investor tax status. But as you're listening, we do have a couple of things that we ask you to keep in mind. The first is that tax law does change constantly. We do make every effort to keep this presentation as up-to-date as possible, but before you rely on the information that I present today to make a decision about your taxes, I do recommend consulting with either a tax attorney or a tax accountant like Traders Accounting. The second thing that we ask you to keep in mind is that Traders Accounting is not a law firm, so none of the advice I give here should be considered legal advice. Traders Accounting is an accounting firm, and for more than 16 years we've been helping traders with all aspects of trading and taxation. This includes helping them set up business entities in order to improve their tax situation with the IRS, helping them prepare their taxes, both for their trading businesses as well as their personal taxes, trust and estate taxes. We help traders with bookkeeping, tracking both their trading activity as well as expenses, coaching to ensure that they're maintaining these entities properly. Then we help traders with their retirement needs through our self-directed 401k plans and their estate planning needs with revocable living trusts. We really try and live up to our motto, you trade and we do the rest. Now, if you'd like to find out a little bit more information about who we are and what we do, we invite you to check out our website at www.tradersaccounting.com. Give us a call at 855-334-7936. Email us at learn@tradersaccounting.com. And we also invite you to check out our blog, the address of which is at the bottom of the screen. Now, today I'm going to be covering quite a bit of information and going through it very quickly. So if you have any questions, please type them into that question comment box as we're moving through, and I'll answer as many as we have time for. But to begin with, I have to start with some pretty bad news. In the eyes of the IRS, you are considered an investor, and this is really a terrible thing to be. This is the default tax status with the IRS. So unless you've taken affirmative steps to change your tax status, you will be considered an investor when it comes to paying your taxes. And as an investor, you're going to pay more in tax, have some additional complications along with your filing requirements, and have to deal with some major tax issues that are unique to the investor tax status. Now, the common definition of investing is pretty straightforward: committing money or capital to an endeavor with the expectation of profit. And this is what most people think of as investing. But the IRS has a much more specific definition. Now, they view investors as people who are buying and selling securities and expecting income from dividends, interest, or capital appreciation. And really they're looking at the long-term income here rather than the short-term income produced by active day trading. They also specify that investing is not a trade or a business, which very much comes into play when we look at the deductions that are available to you related to your trading activities. But with this investor tax status, it doesn't matter what you call yourself. It only matters how you're organized and how you're carrying out your trading activities. But the investor tax status is the default. And unless you take those affirmative steps, you run into the issues that face investors when it comes to the tax code. But the tax code is most definitely not your friend. It has some pretty serious effects on how you report income related to your trading activities, and some pretty serious effects on how you deduct expenses related to producing that trading income. Now, we're going to start with the income side of things. And as an investor, your income typically falls into three categories. First is capital gains, capital losses. The second, ordinary income and ordinary loss. And the third is Section 1256, which applies to futures transactions, some ETF transactions, as well as Forex trades if you've made the right tax elections. But we'll start with capital gains. And just about anything that you own and use for personal purposes, pleasure, or investment is considered a capital asset. And the IRS, and really Congress, wants to incentivize people to hold these capital assets for a long term. As a result, anything you're holding more than a year is taxed at a much lower tax rate, either 0, 15, or 20%, depending on what your overall income tax bracket is for that year. Anything you're holding less than a year is considered short-term capital gain, and so is taxed at whatever your ordinary income tax rate is. Now here you can see that Congress is not really being very kind to those short-term investors. But when it comes to reporting these on your tax return, you do so through Schedule D. And I'm sure you all are very familiar with that particular form. But when you're filling that out, or when your tax preparer is filling that out, it's pretty common to rely simply on the 1099-B that you receive from your broker. Unfortunately, that's just not enough. When you're reporting your capital gains on your tax return, you're required to report the number of shares you're selling or buying, the name of the stock, purchase price, sales price, date sold, and date purchased. And brokers often don't track all of this information. Most of them do, but it is very important to make sure that all that information gets on the tax return. Otherwise, it can really cause some bad tax effects, especially in situations where your broker isn't, for example, tracking your basis in a particular position. And it's pretty time-consuming to track this if you're making 25 trades a year, but as you become more and more active, the administrative burden of properly reporting your capital gains just keeps increasing. On top of that, as an investor, you are subject to two huge tax issues, and these can cause massive problems when you're filing your tax return. The first of these are the wash sale rules, and they're relatively straightforward. So a wash sale occurs whenever you sell a security at a loss, then within 30 days, either before or after the date of that sale, you repurchase that same security or substantially similar one. And when a wash sale occurs, the loss on the initial sale is disallowed, and the basis of that replacement position is adjusted upwards to carry that loss forward. As you can imagine, it's a pretty big headache to keep track of this throughout the year, especially if you're the type of trader that works with a handful of securities. But the biggest negative effect of the wash sale rule really comes when it occurs over the end of the year. And we've got this example to give you an idea of just what that looks like. So let's say that you're a trader who owns Microsoft at $25 a share, and at the end of the year, sell it and take a loss of $2 per share. But because you like that stock, you like the dividend, whatever reason, you get back into it on January 1st of the next year. Now this is a sale at a loss, then within 30 days a repurchase of a substantially similar security. The loss is disallowed, and the basis of that replacement position is stepped up to carry that loss forward. Now this is a huge deal when it occurs over the end of the year, because that loss that you were expecting to take in 2014 has now been carried forward. This leaves you with excess income in 2014 that should have been offset by that loss, and can seriously drive up your tax bill at the end of the year. And these wash sales can be triggered pretty unexpectedly, because trades in separate accounts can trigger wash sales. So if you have an account with TradeStation and then an account with NinjaTrader, trades in those separate accounts can still trigger those wash sales. On top of that, trades in your IRA can trigger wash sales with your taxable accounts. And when that happens, the loss gets carried up into that IRA and really trapped there forever. So when these wash sales occur, you end up misreporting income because you had a loss in the previous year that was carried forward. Because that misreported income is there, you'll end up having additional tax, paying more tax on profits in that previous year, even though they should have been offset by that wash forward loss. And this can, of course, lead to the need to go back and amend that tax return, an additional expense and time costs for you. So these wash sale rules can really be incredibly terrible for investors. And last year we had a client that we worked with who was being taxed as an investor and showed about $400,000 in loss for the year in their account. But because of these wash sales, those losses got carried forward, and they ended up paying tax on about $1.4 million of profit that should have been offset by those wash sales. So you can see that these can have an incredible negative effect when it comes to paying your taxes. The other big tax issue that you can face if you're taxed as an investor is the $3,000 capital loss limitation. And this one's even simpler. You cannot deduct more than $3,000 of capital loss against ordinary income in any given year. So if last year you had ordinary income from your day job of $100,000 and a terrible trading year, a capital loss of $100,000, most people would look at this and see that you made $100,000 and you lost $100,000. So the year was a wash. But because of this $3,000 capital loss limitation, you're left with taxable income in that year of $97,000, and the remaining capital loss is carried forward into future years. Now you can always use this capital loss to offset future capital gain, but even with that loss carried forward, you're still subject to that same $3,000 per year limitation against ordinary income, and at $3,000 per year, that $97,000 is going to take quite a while to write off. So both the capital loss limitation and the wash sale rules prevent you from deducting your trading losses in the year in which you actually took them. But when it comes to capital gains, those are really the biggest issues that an investor faces. But if you work with other types of securities, then there are some different tax rules that can apply to you. The first is the Section 1256 taxation, and this applies to futures transactions, broad-based index options, some ETFs, depending on the makeup of that ETF, E-minis, and things like that. Essentially any non-cash settled option. But for these types of contracts, the 1256 taxation gives them a much lower tax rate on profits. The net gain on 1256 contracts for the year, 60% of that is taxed as long-term capital gain at those lower tax rates, and the remaining 40% is taxed as short-term capital gains, regardless of your holding period. So even if you're in and out of a futures position on a day-to-day basis, you still get that lower tax rate. They're also much easier to report than the standard capital gains, capital losses. You simply list your net gain or loss for the year on Form 6781, identify your broker, and that's that. There's no need to track the same amount of information that's required for those stock and stock options. These 1256 contracts are also exempt from the wash sale rules, so you'll never have to worry about losses getting offset by purchases of similar positions. The only real downside to the 1256 taxation is that the $3,000 capital loss limitation does still apply with these contracts. So you run into that same issue where if you have large losses, you're only able to deduct those against ordinary income up to $3,000 per year. The third type of income that you can have is the Forex income. And any income coming to you from spot or cash Forex is taxed under Section 988. This gives those contracts ordinary income or ordinary loss treatment by default, which means that with Forex trades, there's no $3,000 capital loss limitation, and there are no wash sales. If you have losses, you take that loss in the year in which it was generated, and if you have income, you pay tax on it in that year at the ordinary income tax rate. But it is possible for Forex transactions only to elect to have them taxed as if they were Section 1256 contracts on a trade-by-trade basis. This is not a universal election like the mark-to-market election, which is something that we'll get into a little later on. But with this 1256 election, you simply make it at the time you open the position, and then that contract is taxed under the lower tax rate of Section 1256. But so as an investor, when it comes to reporting income, you need to do so through Schedule D and make sure that you have all the information necessary to properly fill that out and minimize your tax there. This includes tracking wash sales across all of your accounts and making sure those get reported properly. As an investor, you have to worry about that $3,000 capital loss limitation preventing you from writing off losses in excess of that limit. And then you also have to worry about making sure that your trading that falls under Section 1256 for futures or 988 for Forex is reported properly. Now, this is the income side of the equation. Also, as an investor, you have to worry about the possibility of deducting expenses. And as you spend more time with trading, as you get more into education, more into the equipment you're using, your expenses related to trading are going to increase. So the important question becomes, are you able to deduct those expenses against your profits? We've looked over all of our clients and found really these areas are where people are spending money related to their trading activities. Computer equipment, furniture in their home office, the cost of using a personal vehicle to attend educational events, dues and subscriptions for platform and data fees, trading organizations, or periodicals, expenses related to education for home studies, seminars, and trade shows, repairs to their equipment, the expense of having an office itself, bank service charges, office supplies, software, utilities like telephone, internet, and TV, professional fees for tax prep, bookkeeping, and accounting, then travel and entertainment related to a business purpose. And our clients typically spend between $7,000 and $35,000 per year on all of these expenses. But if you're taxed as an investor, if our clients were taxed as investors, then the amount of deductions they could take is substantially limited, because investors, by statute, can only deduct expenses related to dues and subscriptions, platform and data fees, trading organizations, and periodicals, the cost of having an external office, bank service charges, and professional fees such as tax preparation. All of these other expenses are specifically prohibited from being deducted by you if you are taxed as an investor. On top of that, even these few expenses that investors can deduct are taken as part of the miscellaneous itemized deductions on Schedule A for their personal tax return. And there they're subject to a 2% AGI threshold limitation. So you can only deduct those expenses that exceed 2% of your yearly income, further limiting the deductions that you can take if you are taxed as an investor. So the investor tax status, when you're taxed as an investor, you're paying more in taxes. When it comes to the income side of the equation, you have to worry about that $3,000 capital loss limitation. You have to worry about those wash sales preventing you from deducting losses related to your trading. And when it comes to the expense side of the equation, if you're an investor, the deductions you can take are severely limited. So as an investor, you have a couple options. But our suggestion is that as an investor, if you're going to operate being taxed as an investor, you should be working with a tax professional who is familiar with traders' taxation. And make sure that they're familiar with the wash sales, the $3,000 capital loss limitation, Section 1256 and Section 988 taxation, and those deductions that are available to investors. And here at Traders Accounting, we do work with investors. We'll help them with their record keeping, tracking their trading activity as well as those expenses they can deduct, prepare their tax returns, making sure that all that income is reported properly and those deductions that can be taken are actually taken on that return. We help them calculate wash sales for their active trading accounts as well as other individual accounts or retirement accounts that they have, and consulting to help them answer questions about taxes and really carrying out their investing activities. But this really isn't a good option. The better option as an investor is to change how you're taxed. And remember that investor tax status is the default tax status with the IRS. So you need to change your methods of operation, take affirmative steps to change how the IRS views you and how you're going to be taxed. And these affirmative steps really take you to being taxed as a trading business, which the IRS calls a trader in securities. Once you've taken those affirmative steps, it has some amazing effects on your tax situation. When it comes to income, we've run through those defaults, the capital gain, capital loss, 1256 and 988 taxation. But when you're viewed as a trading business, you gain another option, and this is called the mark-to-market election, something that is only available to you if you are viewed as a trading business, not as an investor. The mark-to-market election changes your accounting method, and it changes really how your gain and loss from trading will be treated. Capital gain and capital loss is converted into ordinary income and ordinary loss. On the income side of things, on the gain side, this conversion has no tax consequences because capital gains that are short-term in nature are taxed at the same rate as ordinary income. But on the loss side of the equation, ordinary income can be deducted 100% in the year in which it's actually taken. So by making the mark-to-market election, you exempt yourself from that $3,000 capital loss limitation. It also exempts you from the effects of the wash sale rules. So by making the mark-to-market election, you exempt yourself from the two main tax issues that face investors. All trades are mark-to-market at the end of the year. So if you have an open position on December 31st, it's considered sold for tax purposes, than as if you'd repurchased it on January 1st. But because of the far-reaching effects of this election and the benefits that it can give you, the IRS is pretty particular about making it properly. And the mark-to-market election can be made for an existing business so long as you notify the IRS of the election by the last unextended day to file your taxes for the previous tax year. So if you have an existing trading business, then you've already missed the window to make that election for 2016. Instead, you need to wait to make that election for 2017. However, if you're setting up a new trading business, if you're establishing one at any point throughout the year, you can make the election as part of creating that new business, and so have the mark-to-market election in effect from that day moving forward. So an important question to ask about the mark-to-market election is it the right choice for you? And the mark-to-market election is only available to trading businesses, but it is not mandatory for your trading business. That's because it has huge benefits if you trade with stocks and stock options, because it removed the effects of that $3,000 capital loss limitation and the wash sale rules. But it's not the best election if you trade anything else, because if you're trading futures, for example, and you make that mark-to-market election, you lose the benefit of that lower 60-40 split tax rate. Likewise with Forex, if you make the mark-to-market election, you lose the ability to elect into that 1256 tax rate. It's also not the best choice if you have a large personal capital loss carry forward from previous trading years, because by making that mark-to-market election, you eliminate your typically largest source of future capital gains, leaving you unable to use up that personal capital loss carry forward. So it is very important to make sure when you're making that mark-to-market election that it is the right choice for your individual situation. But by making that change to a trading business, by making the affirmative steps to get out of the investor tax status, you enable yourself to make that mark-to-market election and eliminate the two main tax issues that face investors. Being taxed as a trading business can also have some huge effects on how deductions are handled, because as a trading business, you're able to deduct any expense that's related to trading. You're also able to deduct any expense related to operating your trading business. So we come back to that list from before. Now, as a trading business, you are able to deduct all of these expenses. And the biggest deductions we typically see are related to education, attending the events, travel, hotels, meals, and flights, as well as the tuition for those events themselves. But those become 100% deductible once you are considered a trading business. And I think we can all agree that taking more deductions, reducing your taxable income, is a pretty exciting prospect. So it's important to make sure that we properly substantiate those deductions. And to take them, you really need two things. The first is monthly bookkeeping. You need to have adequate records to show the IRS just how much you paid for those expenses in order to take those deductions. The second is that you need to be a trading business in the eyes of the IRS. And that's a relatively specific standard to meet. But before we get on to the nitty-gritty of being viewed as a trading business by the IRS, one other perk of setting up a new trading business is that you're able to look back at those expenses you paid prior to setting up as a trading business and deduct them as pre-organization expenses. You can look back at least 12 months, and for any expense you paid related to trading, whether it was education, platform and data fees, or even something like home internet that you need to do your trading activities. That can all be gathered up and deducted as part of establishing a new trading business. Up to $5,000 is taken as immediate deduction, and then any excess over that is amortized over 15 years. So when it comes to being viewed as a trading business, the IRS is pretty particular. But if you're an active trader, if you're in and out of the market frequently, if you're looking to do this as a second job or a second source of income, you may be taxed as that trading business. Once you get there, you're able to take more deductions, make those changes to how the income is treated, and provide additional benefits to the owners of that business. And like I said, the IRS calls this tax status a trader in securities. In order to determine if you qualify as a trader in securities, we look at IRS Publication 550, which gives us the special rules for the trader in securities tax status. And it gives us three tests that we use. These three tests take a look at all of the trading that occurs under your Social Security number. And really, they're trying to get an idea of whether or not you are trading like a business would. So the Publication 550 sets forth three rules for trader in securities, and really three tests that you need to meet. The first is that you are looking to profit from daily changes in market price rather than dividends, interest, or capital appreciation. Essentially, that you're looking for short-term profits rather than long-term holding. Second, you must have substantial activity in the market. And third, you must carry on that activity with both continuity and regularity. In order to determine if you meet these three requirements, the IRS has given us three sets of facts and circumstances to be considered. So in order to determine if you're looking to profit from those daily changes in market price, they'll look at the holding periods for what you buy and sell. In order to determine if your activity is substantial, they look at both the frequency and dollar amount for your trades throughout the year. And in order to determine if you trade with continuity and regularity, they look at the amount of time that you devote to that activity. But the IRS doesn't give us a firm holding period, that less than a month is fine, more than a month is bad. They don't tell us a hard number of trades to hit during the year or a hard target for the dollar amount of your trades. And there's no hourly requirement for how much time you need to devote to the activity. And we've reviewed the main court cases concerning this and come up with really some rules of thumb for trader in securities status. The first is that you're active on 80% of the available trading days throughout the year, and that on each day you're active, you place at least one trade. By doing this, you will meet those three requirements: the continuity and regularity, the frequency, and the short holding periods. And while you're doing that, you need to trade while behaving like a business. And I'm sure you've heard the suggestion before that in order to succeed as a trader, you need to trade as a business. Trade without listening to your emotions. trade following your rules, things of that nature. But when it comes to looking at your tax status, again, there's a little bit more specific definition. It's in order to trade like a business, behave like a business, you first need to choose the right business entity structure for your circumstances, keep that entity compliant with any yearly requirements, and keep up with monthly bookkeeping. And I've already pointed out this monthly bookkeeping twice, and I'll do it a couple more times, because it's an incredibly pervasive requirement that the IRS puts on businesses. They really want to see bookkeeping held or kept on a monthly basis rather than trying to track things annually or anything like that. But when it comes to the entity structure for a trading business, you have quite a few options out there. And all of these options have benefits, and all of these options have drawbacks. It can be changed once you've created a business entity, but it may have tax consequences if you change it in the future, particularly if you're moving from a corporation into an LLC or vice versa. But to start with, we've got the Schedule C trading business. And this is also known as a sole proprietorship, just a different name for the same tax status. It is the simplest and easiest to set up of all of the business structures when it comes to trading. But it's really not the best option, because there are some pretty substantial issues when it comes to filing your trading as a Schedule C. The biggest is that it increases your likelihood of being audited. And from a pure structural perspective, the IRS audits Schedule C taxpayers about twice as often as they audit individuals who are working through a business entity. But beyond that, a properly filed Schedule C trading business will reflect only expenses on a Schedule C, while income is reported elsewhere. And if the IRS is looking through returns and sees a Schedule C showing only expense with no income, that does raise some eyebrows on their end. So reading through the Schedule C does increase that audit likelihood. It's also much harder to keep a Schedule C business separate from your individual taxes, because you're reporting them on the same form, carrying out your activities with the same accounts, things like that. So the separation between business and personal becomes pretty hard to see with a Schedule C. And you also aren't able to provide any sort of medical benefit to yourself if you're trading through a Schedule C. Those medical expenses get taken through Schedule A on your return, and they're simply not deductible through that Schedule C business. A much better option, and for most people the best option, is trading through an LLC. And that's because these are pass-through entities, which means the LLC can pass through all items of income and expense to the owners with the same character of gain. They're also creations of state law, which gives them some additional flexibility at the IRS level when it comes to how that LLC is going to be taxed. And it does this while offering limited liability for all of the members of the business, unlike a general partnership where one member of that partnership is required to have general liability. I said that they're creations of state law, and this is a pretty important characteristic of these LLCs that makes them valuable to traders. So the LLCs, they're created by state statute. There is no federal statute that governs these LLCs. So the IRS gives them flexible tax treatment. You can elect to be taxed as a C Corp, an S Corp, a partnership, or a Schedule C. It really just depends on which suits your individual circumstances the best. But when it comes to trading, having at least 2 members in that LLC and electing to be taxed as a partnership is the way to go. Because when it's taxed as a partnership, all income and expense flows through to the owners with the same character of gain. So if you're trading futures in the LLC, that profit flows out to you as 1256 profit, subject to that same low tax rate. And the biggest benefit, particularly for a trading business, is that these profits come out to you with no payroll tax due, unless of course you wanted to pay it in order to make retirement account contributions. but by default, LLCs are able to operate as a business, allow you to deduct all those expenses we mentioned before, while letting you take 100% of the profits without paying payroll tax. So the LLCs have quite a few benefits, but they do have a few downsides. First, with an LLC, you still can't deduct medical expenses. Those get taken through a Schedule A again. You also need to pay tax on profits yearly, even if those profits are left in the entity. Finally, they do have to have 2 members to be effective, and typically we'll set that second member up as the spouse, although that can be a friend or another business entity like a corporation. And it looks like we're coming up on the 10-minute warning, and so we'll run through the corporation structure real quick, then skip right ahead to see if we have any questions. But with a corporation, this is another option for trading business and does allow you to provide additional benefits to yourself and your family. It's also considered a standalone business entity, which means that it does pay its own taxes, albeit at a much lower rate than you and I pay the tax. But with a corporation, it's the best option if you want to pay yourself and your family a wage. And then it's the best option if you want to make retirement account contributions for yourself and your family sourced from those wages. It's also the only option that allows you to provide medical benefits to yourself and your family. But with this corporate structure, there are some downsides. Payroll taxes, double taxation if you choose to pay a dividend, and it does pay its own taxes, so the corporation does have its own tax bill. Now it is possible to have a corporation and an LLC working together to give you the benefits of both, where that corporation provides benefits and pays expenses, and the LLC generates income and passes those profits out to you with no payroll tax due on those trading profits. And we like to see traders use these business entities because it provides a clear distinction between your business and your personal trading. It also substantially lowers your audit risk from trading as a Schedule C business. And last, and certainly not least, it allows you to recapture and deduct those previously paid trading expenses, bring them into a newly created business and allowing you to deduct those on your taxes for that year. And so with these structures, it is pretty tricky to make sure that you're choosing the best one for your individual circumstances. And so as a thank you for listening to me today, we do offer a free 30-minute consultation in order to discuss these business structures, your individual circumstances, and whether or not setting up as an entity is the right choice for you. Now, if you'd like to set something like this up, please give us a call, 800-938-9513. Email us at ravenj@tradersaccounting.com, and we can get that set up. And I do want to stress that this is not, in fact, a sales call. Our main goal here is to make sure that if you do choose to move forward with setting up a business entity, you're choosing the right structure, the one that's going to save you the most taxes with the least amount of overhead. And so please, if you're interested, please send us an email, give us a call, and we can get that set up right away. But so in today's presentation, I tried to give you a really good overview of what the tax situation for investors and for traders looks like. But the big takeaways are that under the IRS's rules, you are considered an investor. This is the default tax status. And as an investor, you're treated terribly by the tax code. You have to worry about the effects of wash sales and reporting those properly, and you have to worry about the effects of that $3,000 capital loss limitation preventing you from deducting your losses from trading. You have to worry about the fact that as an investor, your deductions are substantially limited, and you have complicated reporting requirements for filling out that Schedule D. So if you are trading as an investor, please make sure that your trading is being reported properly and you're not paying excess tax on that trading income. but then it's only through affirmative steps that you can escape from that investor tax status. The easiest of these steps is to trade through a business entity. By doing this, by getting into the trader in securities tax status, you free yourself from the effects of the wash sale rules and the $3,000 capital loss limitation. You remove the limitations from your deductions related to expenses that you're spending related to trading, and it allows you to take advantage of the perks of owning a business, being able to look back and recapture those pre-organization expenses, and being able to provide benefits like 401k and medical plans for yourself and your family. And so that is going to finish up the presentation. Looks like I do have a couple of minutes left for questions. So if anyone has questions, please type them into that question comment box. We'll answer as many as we have time for. Then we also do have some handouts available. So if you're interested in copies of the slides, a list of deductible expenses, a recording at least of a previous webinar, and then the requirements to be a trader in securities, please email me at learn@tradersaccounting.com and we can get those sent out to you. But with the 5 minutes I have left, looks like I'll be able to answer just a few questions at least. Mel asks about the in-meeting trading by being in and out of the market, let's see, 2 to 3 minutes a trade. And for something like that, that would fall under the Section 1256 tax treatment. And so you get that lower split tax rate regardless of the holding period. Michael asks, does the mark-to-market election apply to all your investments or only those run through the entity in which you trade the securities? I have most of my investments with an investment firm, and would the proceeds from those accounts be impacted by the trading business? And that's an excellent question and really one of the biggest reasons to trade through a business entity, because the mark-to-market election would apply only to the trades being carried out in that entity. So the rest of your investments would not be impacted by that mark-to-market election. And this allows you to keep the benefits of long-term investing going on in other accounts while using the mark-to-market election for your short-term trading inside that business entity. Bob asks, are profits reported on 1065 from futures trading subject to self-employment earnings? And this is really a specific exemption carved out by Congress, and that if you're operating through a partnership filing Form 1065, futures trading is not considered self-employment earnings, and so you would not be liable for those self-employment taxes on that income. Richard asks, is there an entity which will work well for an American living abroad with the foreign earned income exclusion? And absolutely. We do work with several clients that are living abroad, and well, we can certainly talk about that in more detail. Definitely a good question for that 30-minute consult. Karen asks, which state do you use to set up the entities? We use every state. Typically we find that the state that you're living in is the best choice for setting up one of these business entities, but there are some exemptions out there. Particularly if you're looking at setting up in a state like Nevada, Washington, Texas, or Florida, you can gain some tax advantages, but that can be offset by the cost of operating a business in another state. So we're definitely familiar with working with all states and can help you set up wherever you'd like to. Looks like I'm just about out of time. So last question, Levi asks, I have an LLC set up for an entirely different business. If I set up another LLC for my trading, will that create problems if I use the same office, computer, etc.? And the big issue there really comes into play when we talk about accounting. If you are using the same office equipment for multiple lines of business, we do have some flexibility in where those deductions get taken, just so long as we make sure that we're not deducting those expenses twice. But we do work with a number of clients who have that exact circumstance, and the main thing there is just to make sure that the bookkeeping is done properly so there's no double dipping for those expenses.